This is Barry Knapp with Ironsides Macroeconomics. It's Monday afternoon, 5:15 Mountain Time on Monday, President's Day, February 16th. You'll be receiving this tomorrow morning. Hopefully it'll be snowing hard here in Vail. That's the expectation, something that hasn't happened all that much this year. Our note this week was titled AI Disruption and Monetary Policy. It was a very dense note with 5 important sections to it. I'm not going to be able to do it justice in this abbreviated video. This is why I'd strongly suggest you become a paid subscriber to Ironsides Macro. But the AI disruption and monetary policy theme builds on what we've been talking about, frankly, since 2022, when the Fed started tightening, or late 2021, or even into 2021, when we thought their policy was excessive. They eased primarily using their balance sheet. They tightened using rate policy. They've created the K-shaped banking, small business, and household sectors. And this whole concept applies to the whole Gen AI infrastructure boom as well. Those borrowers, hyperscalers, are super high quality borrowers who have access to funds at 50 to 75 basis points below where the market would set those rates in the absence of the Fed's $6.5 trillion of balance sheets. In exchange for that, the Fed is keeping the policy rate 50 basis points higher than they would otherwise for Main Street, small mom and pop real estate developers, small construction companies, small banks, small businesses. This is a very reckless strategy that risks an investment or a malinvestment bust. This was not evident in the 60s when we had an investment boom, not evident in the 90s when we had an investment boom. The Fed had a bills-only policy. They didn't hold any longer-term securities of consequence, and they actually held real interest rates at positive levels throughout those business cycles. This is bad policy. We then moved on to talk about the resistance at the Fed and some of the developments that we think will move us towards the Besant plan, a steeper yield curve, bank regulatory relief. There was an important Vice Chair of Supervision Bowman speech this morning on Monday. It wasn't contained in our note because it came out this morning, about the banking system being pushed out of the mortgage servicing business, the mortgage lending business, and trying to encourage that, providing some concrete steps to get them back into the business. But there's some important stuff going on there. A lot of details in the notes for our client full paid subscribers. The chart I have behind me here is the dog that didn't bite. We've had 2 months in a row of 0.0 readings for core goods prices. Shelter prices are on their way. They're back to pre-pandemic trend, on their way lower. Non-housing services, or so-called supercore inflation, is back to its pre-pandemic trend of 2.5%, and may head lower because government spending growth is 2%. That was the lighter fluid on the flame of that part of the inflation story. And so we are in a disinflationary trend. No ifs, ands, or buts about it. And the Fed should not be fighting this. The inversion of the 3-month bill to 2-year curve is a very clear signal. The near-term forward spread, which is the 3-month rate, 18 months forward less the spot 3-month rate, really close to the 3-month, 2-year part of the curve, is also inverted. The Fed research from the Fed shows that's the part of the curve that contains the most information about the economic outlook. The gang of 4 that's fighting, further rate cuts are totally off base, and Fed should be cutting. The payroll report, there was a lot less than meets the eye there. All sorts of problems with seasonal adjustment factors. One important fact for you: unadjusted job growth in the month of January every year, 25, 30 past years, goes down by over 3 million jobs. That's just how the seasonal patterns work. So any job creation you see is statistical smoothing. They've struggled with that statistical smoothing since the pandemic, and they struggle with it again this month. The labor market is not stabilizing. It's not accelerating. We didn't quite get the zero zip data when we saw the benchmark annual revisions. We got pretty darn close. So there was no job growth to speak of. Wages are under pressure. There's your most important signal, and that this is not a problem. Next section of the note, we went on and discussed the budgetary outlook. We had good news in the short run because government spending growth is only 2%, but the CBO still thinks it's probably headed to 24 over the next 10 years. There's things to quibble with them about, but their caution is definitely warranted. We need to slow the growth rate of healthcare spending, Medicaid, Medicare, Obamacare subsidies. That's the only way we're really going to stabilize the debt over time. Government spending needs to be returned to 20% of GDP. So we made some sector changes for paid subscribers. We threw the numbers in the front of the note. You can see what they are, but we're not going to walk you through the whole asset allocation. That's what you get when you become a paid subscriber. Barry and F from Ironsides. Have a good week, everyone. Thank you.